All right, let's go ahead and get started. All right, welcome to the February session that we regard as just investing topics, stuff to kick around with Ken, Mark, and friends. But we refer to these often as Turnout Tuesdays. Again, turnout's a good thing. And my name is Mark Robertson. I'm founder and managing partner of Manifest Investing. We co-sponsor these events in collaboration and corroboration with the Mid-Michigan chapter of NEIC, or Better Investing. And I'm joined here by my friend Ken Kavula. Say hello, Ken, if you're not covered with ice yet.
I'm still here. No ice yet, but I'm watching for it.
Ken is renowned for his interest in smaller companies, and we'll hear about some of that tonight. Not a full slate of small company stuff, but at least a nibble, because you should always nibble on those type of companies. But just long-term success in investing and his participation in dozens of investment clubs. So with that, I think we'll go ahead and get underway. If you have any questions or want to have any follow-up, Ken's email address is on the screen, kkavula1@comcast.net, and mine is there also, markr@manifestinvesting.com. And those of you that are familiar with the Groundhog, I have finally emptied my inbox of Groundhog entries, and we should be up and running for the 2019 campaign. So we're going to talk about a few things: investing returns over the years, this notion of respect and the queen up there on the right, Aretha, and the fact that Yukon Cornelius was right about Bumble's bouncing. And the Bumble market that we had in December had quite a bounce in January and early February, and it's actually been quite good so far. Let's go ahead and get the paperwork out of the way. We will be talking about real stocks in real time. Keep in mind that no investment recommendation is intended. This is about education and the very powerful word demonstration. Everything we do is for illustration, and please keep that in mind. Please do your own homework. When we talk about companies, we will try to remember to tell you if we actually own some or know people who do. If you have a friend or family member who you think might benefit from these educational programs, between the roundtables and the investing topic discussions, send a note to Natalie. That's at nkavula1@comcast.net. And I promise you, Natalie will not flood you with spam. You'll get a couple of reminders per month, and she's pretty good about that. Well, here's our agenda for tonight. Again, welcome. This is a little bit less structured than the roundtable programs in terms of we just basically try to go to areas of interest that we know are on people's minds. And so we picked out a few topics here. We'll take a look at one of Ken's favorite graphs on, what to expect as far as returns year to year in the stock market. We will review very quickly. I'll try to do a quick but fairly deep dive into the Groundhog 2018 results. Again, we had a fairly decent year, a little bit different because of the way that the year kind of played out. Ken has a special session on RESPECT and a recent contribution from Forbes. And then we'll spend a little bit of time talking about this notion of better selling and the debate we've been having on how to deal with individual or partial lots within a composite position. And then again, we always want to know what's on your mind. We'll try to do this in a timely manner so that we leave some time for Q&A, but we'll roll with that. Any comments or questions, Ken?
No, I'm ready to get started, Mark. Sounds exciting.
Okay. Well, let's go ahead and talk about this one. This is one of Ken's favorite charts. Take it away, sir.
I just love this graph, and it's not very pretty, and it's kind of difficult for some people to understand, and I use different versions of this chart as I'm teaching my Why Invest class. We use 3-year versions and 5-year versions and try to show what's going on, but this is nothing more than the returns from the value line arithmetic index since about 1980, I think. 1981 I see on the chart. That might be the beginning date that we started this particular graph. It's the VLE is the value line arithmetic index. And basically what we're trying to do is validate that number that we give to you all the time. We talk about the market, and I always use the words, depending on how you measure it, the market has an average return of somewhere just around 10% or so. So we've been putting a new block on this chart every time a year goes by, and we've been doing it since 1980 or so, and you can see that we're starting to develop a really nice bell curve, and the middle of that bell curve is happening just at about 10%. That's a true fact whether I draw this particular chart for another large index, say the Standard & Poor's, or whether I pick something like the Vanguard Total Stock Market Index. I can draw these charts for all of these different indexes, and I can get a picture that looks roughly like this picture here. Now, of course, the bars might be different, up one, down one. I might have a little bit less spread or a little bit more spread. But all in all, this 10% return for the market that George Nicholson knew all about in the 40s when better investing was just kind of a germ of an idea in his head, he knew that the market had returned on average in his history about 10%. And here we are in the last approximately 40 years, and we're still seeing about that 10% return. Last year wasn't particularly nice to the value line index. It's a pretty broad index made up of somewhere around 1,700 stocks that are in the main value line edition. But last year, I think the loss for the market was for that index was around 11%. So that would put the bar in that -10 to -20 column. Notice that's only happened 4 times in the last 40 years or so. One time, a really big loss, and we can all remember that, and we can all remind ourselves that we hope that's a once-in-a-lifetime kind of aberration to the curve. But lo and behold, on any good bell chart, if you're going to see an aberration to the left, like we're seeing here, you're also going to see an aberration to the right. And while I'd love to have another year like 2009, where in my memory that was by far the best time for me ever to have been an investor, where the value line index accomplished a plus 60% value to it. Again, it's an aberration, and the average sits right in the middle of this nice bell-shaped curve, and we're going to say 9, 10, 11%. I've asked people to think about that as I show this graph, because a lot of people have asked me where my number comes from. It's an oft quoted number in better investing lore, and you hear it on the Talking Heads channels, the Fox News channel, the CNBC channel. You hear that 10% being referred to an awful lot over the different programs that occur. So I just thought I'd show you this, and I'll keep doing this for as long as it interests me. The graph's fairly easy to put together. Any one of you can do it. You can go to any one of the data sites, look for historical data, and look for closing prices, and you can start way back in, well, you can start it back as far as the index goes in history. For the S&P, for example, I think that index goes actually back to somewhere in the 50s. So you could put together data that starts somewhere in the early to mid 50s, way back there. Mark, any comments on the graph before we go to the next chart?
Well, just a couple things. Those who remember the go-go 90s with fondness, that's what the green ones are in the middle there. And I had just basically started. The other thing that kind of warms me up on these cold, icy days here in the Michigan tundra is I can remember conversations I had, and I don't think I'm out of school here, Ken. Ken and Natalie had taken direct responsibility for much of their retirement planning back in that time frame. And I can remember, I just have this vision of Ken and Natalie sitting side by side at their two desks, just having a heck of a good time shopping back in late 2008, early 2009, and then clinking the glasses later on that year when they obviously were quite rewarded for their direct investing retirement accounts. And I just have a good time with just thinking about that. And again, this should serve also as a reminder. Remember, part of our theme around here lately has been don't be surprised by something you shouldn't be surprised by. And I don't think there's anything that anybody can humanly do that can predict what will happen for the next year. None of the tools that we use, you can't do it with technical analysis. There really is no way to predict what will happen for any given 1 year. And you just have to accept that as a fact and just notice how these things have bounced around and accept that. And then also accept the almost annoying counterintuitive moment that it's actually easier to predict a 5-year situation than a 1-year situation using the methods and practices that we use. And it's something I've talked about at length with Mark Hulbert, Hulbert Financial Digest and Market Watch. And this graph just helps to remind that you shouldn't be surprised by any 1 year. You can't predict it. That's why it's crazy to see these guys making the 1-year market predictions and all that kind of stuff. So, all right, I'll come down from the soapbox now.
Hear ye.
Okay. Well, again, in the mode of not being able to predict something, I just want to show this very quickly about how quickly the tide can turn, how dramatically right somebody like Yukon Cornelius can be. Yukon Cornelius, for those not familiar, he's one of the stars of Rudolph the Red-Nosed Reindeer, and he's the guy who talks about the abominable snowman, who they name Bumbles, and he says Bumbles bounce. Well, back in mid-December, the stock market was coming off. The lug nuts were loose, and things were in pretty bad shape. We'd had a terrible October, a good November, and then an even more terrible December. And back in that time frame, we were basically looking at a number of market indicators which were suggesting things as bad as 2008 possibly, and or as bad as 1998 could have been. And we just kind of crossed our fingers and hoped that some of the mechanics would turn. The indicator that you're looking at here is nothing more complicated than comparing the number of new highs and subtracting the number of new lows. That's the areas that you see, the green and red areas that you see. We kind of track that blue line as a kind of an indicator down the middle. If that thing really does fall apart like it did back here in 2008, where that blue line dove down and stayed down there, you do have a situation. For somebody close to the end of their investing horizon, that's a moment to definitely heed. Well, we had one of those pretty much taking shape back in December. In fact, I actually went through the thought experiment of should I do something different with mom and dad. They happen to be 20 years older than I am, and actually had the thought of do we need to protect some of those assets. Didn't really do it because I just see so many positive indicators. We'll cover that here in a minute. Well, lo and behold, just literally a few weeks later, this has reversed course. We actually have more companies setting new highs than new lows, and it really has snubbed that danger signal, basically turning what we're going through right now into something more comparable to 2015 or 2011 than what we saw back 10 years ago. So that's kind of what's going on.
Mark, I'm going to answer a couple of questions that have arisen since we put these two slides up, okay? A number of you want to know what's the significance of the colors on the graph that you just saw, the yearly graph, year by year. And there is absolutely no significance. It's just there so that we can kind of differentiate certain decades from other decades. Mark alluded to the fact that the go-go 90s were in green, and I think that everything from 2000 on has been in yellow, and everything prior to the go-go 90s was in red, but absolutely no significance other than just to kind of keep your eye open on what's happening. To make this graph appear, to make this nice bell-shaped graph appear, you do need enough data. Notice that if I just did data from the 90s, that's the red numbers there, and the 80s, I don't get a particularly nice bell-shaped curve. Even when I add the green in there, I get a little bit better bell shape, but still not real nice. As the yellow moves onto it, the curve becomes more and more matching the normal curve. And as we get more and more data, I fully expect this curve to flesh itself out. Jane Johnson from Western Michigan says, I'm noticing that after a particularly bad year, it's usually followed by a fairly good year. Could that be true for 2019? And Jane, we'll know the answer to that on January 1st, 2020. But for now, all I can say is that it started out pretty well. We've had about 5.5, 6 weeks of really good things, but I don't think I'm willing to draw any conclusions from one balancing the other. I don't happen to think numbers really listen to humans and psychology and things like that. Nick from Pittsburgh says, he says, comment, after each of the four 1 to 20 for 1 to 20 pluses, 10 years followed by plus years. Nick, I'm not quite sure what you're indicating, but maybe you could either let us unmute you and you can tell us, or maybe you'd restate that right here. And that catches us up on questions, Mark. But Nick, if you want us to unmute you, just raise your hand and I'll see if I can. There we go. Okay, Nick, what are you asking about there?
It's bad fingers on my part. My observation is that if you look at the -10 to -20 column, each of those years are followed by positive returns. So 1987, 1988's in the 20 to 30 positive. 1991's in the 30 to 40 positive. 2002, 2003's in the 40 to 50 column. And even if you go out to the 2008 number, the 2009 number is a big number. So you're right. I agree with you. Numbers don't listen to human sensibilities, but it seems like there could be a little bit of a trend here where a down year, especially the most significant down years showing up on our curve, are followed by years that offset on the other side of the curve.
Yep, I'm saying this with a big smile on my face, Nick, but conclusions being drawn like that make my mathematical bones just cringe. So
my accounting bones cringe too, but
I understand what you're saying, and it might very well be. It's the same observation, basically, that Jane Johnson had, that maybe we're in for a good year in 2019. Go on, Mark.
Exactly.
Well, I would agree. I mean,
Thanks,
I would put my knight medieval gear on and do a dance or something, but I agree that I would be more surprised to see 2019 end up on the left than on the right. That's not to say it can't happen, but I'm with Nick. I would be less surprised to see 2019 land on the right side of this chart, and time will tell. So anyhow, let's talk about something even more important, and that has to do with all the talk about recession lately, and that simply is not happening. We're actually at the time of year when Value Line rolls over and starts giving us 2020 estimates and 2023 estimates in their new 3 to 5 year forecasts. So this will be something we'll watch fairly closely for the next quarter. But as you can see, the recession, this is what happens during a recession. Profitability goes down and stock prices get massacred and stock selection guides get blown up. There's no sign of that happening yet in everything going on out there in the macro world. Companies' fundamentals are actually strengthening, and they're going basically up straight and parallel and up to the right, or however you want to think of it. They're headed in the right direction, and there's no signs of tremendous weakening when it comes to this parameter, which is really what is behind recessions and how much they mess with us. So again, just closing with the chart, I believe the blue line is still intact. Doesn't mean we're going to follow a straight line from left to right, but we zagged down pretty hard in October and December, which means that the prices went down, the potential went up. the projected annual return, or the low total return forecast at value line, actually soared to multi-year highs as we had that really nasty quarter, and it's actually relaxed back down into more of a traditional zone, saying that stocks are more fairly valued these days. It's a little harder to find a stock in the buy zone today than it was even just a month ago. So all the indications to me are actually pretty compelling.
I like that graph, Mark, that we just passed on slide 6, because it kind of reemphasizes something that I've kind of been thinking in my own mind since the Great Recession in 2008. And, I understood the loss in profitability in 2009, and then the start of the new bull market in the end of 2009 going into 2010. But I was listening for a lot of years about how feeble, how weak the recovery was. And these profitability graphs kind of point out that from 2010 to, say, 2017, we actually had a slight decline in profitability. And even though we were calling it a bull market, I think we need a new term, a new animal, for this really long period of virtually no profit growth. I think that the bull market really maybe should be measured from 17 through 19 rather than from 09 through 19. And maybe it isn't nearly as long and nearly as worn out as we're thinking that it is.
Yeah, and we've talked about this before. Back in 2016, 2017, you'd run into people that were doing quite well with their investing accounts, but it didn't feel good. It just didn't feel right. And a lot of it was because this was going on in the background. You actually had segments of the economy that were experiencing recessions and rotating through a few of them. So that's what you're seeing in composite. And like I say, people weren't feeling good about it. And by the same token, I don't think people have realized yet, the fundamental strength that is starting to unfold. Now we'll see if some of that goes away and dissipates, but some pretty positive signs there.
Mark, Tom is asking a question. He wants to know, how do we think the 21% tax rate, how will that affect median profitability going forward? I think I have an answer, but I'm willing to listen to yours to start with.
I'd rather hear yours first.
Okay. I'm thinking that it'll have a one-time impact on companies, providing the companies don't choose to do something with the cash that is either, in my mind at least, foolish, or that is not adding to their profitability. I think there are some non-foolish things that companies can do with that newfound wealth that will not add to profitability. If they raise workers' wages, for example, that's not really adding to profitability, and you won't see a jump in earnings per share. Now, stock buybacks, that's theoretically, that's a jump in earnings per share. I'm not always sure that pans out, because I'm not always sure that companies are the best judge as to when they should be buying their own company's stock. And I think a lot of companies make some real boneheaded decisions on the best time to buy their stock, and they end up buying high and selling low. And that's not particularly a good strategy to use for the long term either. I think that whatever happens, however, will be kind of a one-time reset, and then we'll be looking at things back under the lens of the new normal, whatever that happens to be, and we'll have to judge at that point whether or not that has reset the whole profitability picture, or whether the profitability picture has stayed roughly the same, even though taxes have shifted significantly. So what's your answer to that question, Mark?
Well, I like bonehead. Yeah, I agree. I think that the companies have been given a very generous opportunity to do the right thing. I am massively disappointed in human nature when it comes to this. I'm far from a socialist. Anybody that wants to have those thoughts, but by the same token, I think we do have a current opportunity to to fix some of the stagnant wealth situation, especially in the middle class and lower middle class, that has been in place for decades. Executives have an opportunity to do something about that. By the same token, they can invest in really smart stuff, whether that's their own stock, which they have a terrible track record at, as Ken was saying, bonehead. So I think that monitoring what companies do with that opportunity is a really important aspect of stock studies going forward. Trying to gauge, did they deploy it in a way that basically strengthens their stakeholders, and that includes employees, when it comes to something like this. So yeah, I think Ken's right. It's a one time, but it's a step change until the change is back in the other direction. So yeah, think of this as a chart with two halves where there's a whole set of different laws in effect to the right of that line. So yeah, we'll see. Let's all pray that they do less boneheaded things. So with that, I'm going to just quickly dive into the groundhog. Did you have something, Ken?
No, I was just going to say, I see Mr. Groundhog on the slide here, so it must be time to talk about the contest.
Well, yeah, you know what really makes me sad, Ken?
That you didn't get to see this young man in person, right?
I'm getting letters from people like Mary Treppa that say her brother was there yesterday or 3 days ago, and they're all telling me, yeah, we went to Punxsutawney, and I'm like, gee, I had the opportunity to go there one day. And
all right. Now you better tell that story at about a minute mark, or people are going to wonder what you're talking about. I heard, by the way, a couple days ago that Punxsutawney Phil is really a girl. So I just want to put that out there too.
Oh, here we go. And more. Did you read that checking out at the grocery store? Or?
No. I heard that on one of the financial channels.
Okay.
Well, they were going to, for those purposes of honesty, they were announcing that. So.
Okay. Well, for those, we're starting to lose a few people, Ken. We better get on with it. Groundhog Day is a national holiday at Manifest Investing. It's a national holiday because it's the day we were born. Back in February 2nd, 2005. So it's our birthday, it's our anniversary. It should be a worldwide celebration, and we try to make it so. We have a stock picking contest every year that runs from Groundhog Day to Groundhog Day. We've done it for 12 years, and we have just started our 13th annual running of the Groundhogs. Have a lot of fun doing it. Just for a frame of reference, we've been doing it, like I said, 12 years. The average return to somebody playing along has been 10.4%. Matching investments in the Wilshire 5000 would have checked in at 7.5. So there you go. That's a relative return for the average groundhog participant of 3% over that 12-year period. That's a massively big number, believe it or not. It's just fascinating to watch. When we got started doing this, we thought, wow, there'll be people swinging for the fences, trying to buy something just north of penny stocks. And that has turned out to not be the case. People kind of will be a little bit playful with trying to look for very short-term opportunity and catalysts. But in general, the groundhog participants, there's about 100 this year, generally are selecting very high quality stocks and positioning themselves well for the long term and hoping for the best when it comes to the short term period of 1 year. So we have a lot of fun. Here are the results for 2018. These are the participants who beat the Wilshire 5000 over that 1 year period. 42% of the participants did. You can see that our individual champion for the second time in 4 years is Anna Gambar of Holly, Michigan. That's her on the right in the photograph. By the way, her husband about a month ago was in the number 2 position. He actually finished at 6th on this list, and he was number 2 at the time. So that must be interesting at Anna and Rod's house when they're looking at the scoreboard and battling things out. But Anna won for the second time in 4 years. We jokingly say that inviting Anna to a stock picking contest is like inviting Tom Brady to a football tournament. Things are going to go pretty well for Tom Brady in most cases. So they win the individual contest. There's a number of people that have finished near the top. Norm, who we were trying to talk to in the green room before, is actually on the leaderboard here. Norm the Badger. And you can see everybody came in at a little over $1 million. You get $1 million to start a year ago. And one of the things that doesn't make me sad, Ken, is when I looked at this about 2 weeks ago, there were only 4 entries that were actually greater than $1 million. And you can see what the last couple weeks of January did for a whole bunch of groundhogs, looking down the way there. So you can see Anna's selection. She had Nick Strategos's Five Below. Alta was by far the most commonly selected stock by everyone last year. Market Access is in there, Celgene, and Cognizant Technology. So you can see how Anna put together the 6-stock portfolio that actually led to that 24% win.
Mark, we have a question from Haney, and I'm going to unmute Haney, okay?
Okay.
Haney, go ahead with your question. Haney, you must be muted on your side because I can't unmute you.
Okay, well,
Mark, go ahead, and I will continue to try, okay?
Okay, no problem. The winning group entry was John Kimmel's Plymouth Investment Club out of Wichita, Kansas. This year was kind of interesting. It came down to
Muted.
Fields and
Unmuted.
McCoys. Got Haney back now, do we?
I'm trying.
Okay.
Nope, I'm not able to. Okay, go on.
So you're familiar with the Hatfields and McCoys. Well, our group contest has kind of evolved into the Kimmels versus the Kavulas. Both John Kimmel out of Wichita, Kansas, and Ken are active and involved with, I say, 19 investment clubs each. So you can see that a couple of Ken's entries, the B.I. Baker, which is a model club out of Flint, and the Wolves, which is family and friends club that he runs, are right there neck and neck with a couple of the Wichita clubs and John Kimmel. And just kind of neat to watch the battle go down. And you can see the winning entry from the Plymouth group there. Again, they picked Five Below as favored by Nick Strategos. And good stuff. We also keep track of institutions, newsletters, that type of stuff. We put them in a Rhino category. And this year, once again, Brown Small Company Mutual Fund actually comes in at 9.3%, almost 9.4% year over year to take the Rhino category, institutional category. And again, just we point out that it's not a mistake. It's not an accident. These guys beat the market by 10% this year, and over 15 years, their relative return is around 4% or more, 4 percentage points. And we really do recommend that when we find a small company professional who knows what they're doing, and Brown certainly seems to. We watch the portfolio. Those are the top 20 or 25 holdings at Brown Small Company. And for instance, you might take a closer look at Glaukos down at the bottom there. That's a brand new holding within Brown Small Company. Notice some of those first purchase dates on the far right. These guys latch on to an idea with high conviction, and they hold on to it for quite a while. A lot of household names for our small company investing efforts on that right-hand display. Any comments or questions, Ken?
Oh, I noticed that one of the biggest holdings in B.I. Baker is the biggest holding in Brown Small Company, the Proto Labs. It's a large B.I. Baker holding, and it's a large Wolves holding as well. These portfolios from B.I. Baker and Wolves were basically made up of the top 7 or 8 stocks from a manifest dashboard that the clubs actually own. So these weren't random choices. These were portfolios made up of what the clubs actually own from these two. Now, it was selecting not the entire portfolio, but the top 6 or 7 choices. But still, it speaks well to how how much time the clubs put in, and the kind of good stocks that they choose to add to their portfolios.
So with that, we also pay attention to the long term. Like I said before, a lot of the participants certainly seem to keep one eye on the 1 year time horizon, but the other eye definitely focused on the long term perspective. So what you're looking at here, it's ranked by the relative return on these investors from that have been in a number of years, starting with Broad Assets out of St. Louis. They've actually won the group competition 3 times in the last 6 years. And they had kind of a rough year. They were down 10% this year, so they allowed us to catch up with them a little bit. But they have generated, in the 7 years of participation, a return of 28.9%. That beats the market by 16.3%. That's over 7 years. That's just phenomenal. Another one of our Michigan buddies, and he's a one-time champion of the Groundhog, Paul Witt, just continues to chug along. He's not living off that one-time thing. He's up there at the top, and you can see a number of their participants in our programs, knights and damsels, listed on this list. And again, this is people that have been doing it as much as all 12 years from top to bottom. The one thing that I would point out for this audience that I find kind of fascinating is people like Nick Strategos, Ken Kavula, Susan Michelik, John Kimmel. A lot of times they're very involved in clubs, and I'd like you to notice that the long-term club out of Wichita, Nick's club Sirius in Pittsburgh, Peter Phillip and Bartlesville. Bartlesville is actually beating his personal entry. What we seem to see an awful lot of. Look at Bauer City, and Susan's just off this list to the downside, where the club is actually outperforming the individual. Kind of a compelling or intriguing thing to me. All right. Any other questions or comments, Ken?
No, it's interesting to see all the data you've put together, though, Mark.
I just get so tickled when I look at how well these have done over the long term. It's it's becoming the sample size is getting bigger. I don't know when it's big enough, but it's getting bigger. All right, we'll go ahead and transition into the next part of our program with Aretha Franklin here in a second. But I did want to remind everybody that we will be getting together 3 weeks from today. I don't think President Trump is scheduling a speech for that night yet, so we might be safe there. But it will be our annual award program, and we basically just take a look at, again, the 1 year results and the long-term results for the Investing Roundtable. And we invite you to join us for that. Tuxedos and evening gowns are optional, I think. Right, Ken?
No costumes, Mark.
No costumes. Okay, here we go. All right, it's time for some RESPECT and Aretha Franklin. We'll let Ken take it away with the admired companies here in a minute. Admiration and respect kind of run together. I took this picture at a Detroit Tigers baseball game with my cell phone, walking down to our seats. It was a couple days after Aretha had passed, and you can see that the scoreboard is lit up in her honor. And look at the rainbow. I think it's one of the best pictures I've ever taken, and she was quite a gem. There was some talk of her songs and singing this weekend at the Super Bowl, and some good stuff there. All right, let's go ahead and take it to a list that Ken has shared with us recently, again, as a source of ideas and affirmation and etc.
Well, I still am a big magazine fan, Mark, and I have probably, 20, 25 different magazines come to the house, and 4 or 5 of those are financial magazines. I still get Fortune and Forbes and Business Week, which is now Bloomberg Business Week. I still get those on print version as well as online version. But my Fortune just came, and when it comes, I like to sit down and and read whatever tickles me most. There's a great article that fits our demographic, and I'll digress for just a moment. A great article about Alzheimer's disease and the way that we're searching for cures and searching for new drugs and a whole new paradigm on how they might be finding a way to deal with Alzheimer's. If that has any interest to you, I would really suggest the article in the Brand New Fortune. The cover story is just called Alzheimer's, so look in the magazine. It's a 8 or 10 page article, and it's really interesting. What I dealt with first, however, in the magazine was the fact that they put out a new list, and the list was the world's most admired companies. I've been looking at this list now for the last 4 or 5 years in Fortune magazine with the thought that if a company is really admired by its peers, then it might have some real investability attached to it. Now, this is 100 companies. They give you the criteria for how they choose those 100 companies. There's actually 101 companies on the list because there's a tie for the last spot. But when it's all said and done, my expectations were that I was going to have a list of very large, very slow growing companies to take a look at. Well, I was pleasantly surprised when I found out that there were not only large companies on this list, but there were 1 or 2 private companies, there were some non-United States companies, and there were some medium-sized and a couple of small companies on the list as well. I think it's a great start for a beginning investor especially. I was surprised at how many of these companies I either owned in my personal portfolios or I owned in one of the club portfolios that I'm a part manager of. And we decided to put it onto a dashboard and then to publish it. So if you go to the opening home page of Manifest Investing, look over on the right as to public dashboards over on the right-hand side of the home page, and then it's not listed right there. You have to click more, and this dashboard is listed under Fortune Most Widely Admired 2019. And Mark's put in a URL for you to take a look at the dashboard, even if you're not a member of Manifest Investing. So it's not at the bottom of this page right down there. It's at manifestinvesting.com/dashboards/public, and then there's a code. And if you put that in, you'll be able to take a look at this as well. The list starts out the kind of way you might expect. Apple is the world's most admired company, followed closely by Amazon. They're in the same spots that they were last year, spot 1 and spot 2. But when you go in and put them all on the list, you get the names of some companies that you may or may not be really familiar with. What I found very interesting, however, were the portfolio averages for these kind of companies. First of all, they had an aggregate quality, and since I put $100 into each one, and this I think is 2 days old, this screenshot, so you can see which ones are pulling to the top by the values that are off of 100 right now. They had an aggregate quality of 85. That's exceptionally high. That matches good, solid, better investing portfolios that I look at all around the country. And that means that the people that are admiring other companies admire the kinds of things that we give credit for in a quality rating. They admire profitability and financial strength, and they admire the kinds of things that we think are important when we're making our investments. It had an aggregate par of over 9%. And you know, if we were looking at a bunch of really large, slow-growing companies, I would be surprised to see that par at 5 or so. But here we are with a par at 9, which is actually a little tiny bit above the average par of 8.9, which was measured when this slide was put together. It's labeled my par. That's just the average par number from the manifest database. And this group of stocks had an average par of 9. The one number that blew me away, however, was the financial strength number. I've always asked for financial strength in the companies that I'm looking at of 80, 85, sometimes even 90. And this entire group of about 95 companies had an aggregate financial and average financial strength number of 90%. So whoever's judging these companies, whoever's voting on what they admire, is also making a big pitch based on how strong are the finances that support these companies right here. It's an extremely interesting list. Mark has sorted it by financial strength. The first thing that I did when I got to it, I'm sorry, by quality. The first thing I did when I put this into the dashboard was to sort it by par. I wanted to see if there were some of these companies that might be investable right at the moment. There are, by the way. And I want to draw your attention. You won't find 101 on this list because there's a few that aren't being traded in the United States, and those are up there at the very top. There's 1, 2, 3, 4, 5, 6. Publix is a private company, and the other ones are large companies, but they're not being traded as ADRs in our markets. So you kind of want to keep that in mind when you're looking at the list. There are a few missing, but the ones that are here, it's a great source, I think, for ideas, especially for those of you that are just beginning to put a portfolio together. I think you could do a lot worse than stick with the 15 or 16 companies that you're looking at right here on this slide. And this is only the top quality, going from 100 down to the 93rd percentile right there. I doubt if there's very many names on that top quality list that most of you don't already know. Maybe Accenture is one that's a little bit harder to discover. But for the most part, these are some of the most admired companies by Better Investing members. They sit in our top 100 stocks in Better Investing, and they also fit the criteria from Fortune magazine here. I just thought it was an interesting exercise, and when I had a few minutes, I put the dashboard together, and now I share it with all of you.
Yeah, I would encourage you to all go take a look. One of the things that I did when Ken showed it to me is I grabbed the data and threw them on a chart, and what I wanted to look at was a potential relationship between the quality rating and the projected average PE. Again, quality ranking being somewhat analogous to admiration or respect, and the higher the respect, the higher the PE ratio in general. And it certainly does pan out. I did have to leave out Amazon and one other company as outliers because their PE ratios were basically 4 feet off the top of this chart. But you can see a nice general trend that aligns pretty closely with the instincts that we have as investors. Again, the higher the quality of the company in general, the higher the PE ratio. And we see that play in and time out. So it's kind of neat to see that unfold. That's something that could be shared with investment clubs just to underscore that instinct. Good stuff. All right, so let's go ahead and talk a little bit about our partial position situation. Again, this is part of our Selling Better thing. We won't do the full 1 hour presentation, but this goes back to a work in progress, something that we're working on to try to identify some, I don't want to call them algorithms, but certainly guidelines that can align with these conditions. And many of you, if you are not familiar with this, send either Ken or me an email, and we'll give you a couple of articles which give you more of the background on what we're talking about here. What we're talking about here tonight is the thing that we discovered to be more closely related to the rule of 5, that being when you do 5 stock studies, 3 of them work out pretty much as you'd expect. 1 will outperform your expectations, in some cases dramatically, And then usually out of every 5 companies you pick, something's just going to go, haywire. It's just going to be wired badly or whatever. And it's not a matter of you doing something wrong. It's just something that it's just not working out for the company. In response to that, what we took a look at was William O'Neill's selling discipline for his momentum-based, and this is more trading-oriented. And as you can read here, we basically tried to come up with something that's a little bit less trigger-happy, and that also reflected a position relative to the market. And we came up with this notion of tracking the actual relative return, the return in comparison to could be the S&P 500, the Wilshire 5000, or whatever. But when the return that you see from your selection, the decision that you made, actually lagging or trailing the market by more than the 20%, in other words, down more than 20%, you want to consider a timeout for that position, perhaps selling it, certainly putting it under a much more intensive scrutiny. And these are the types of things that we've been chewing over here the last couple of years, and in particular for this one over the last several months. The one that has come up during roundtable discussions in recent months is Alliance Data Systems, because that one has been, to put it mildly, weakening. And it's been selected a number of times. At one point, it was selected, I believe, 7 times for the roundtable tracking portfolio. We've actually already sold one position. We'll look at that in just a second. But again, we're comparing the return on that position, that one decision made, and comparing it versus the Wilshire 5000. And anytime that number is less than minus 20, basically selling or walking away from the position. For those of you that have grandchildren, that timeout thing applies. So this is the debate we're having. Does it make sense to sell one position? Should we be selling the whole thing when any one piece of it goes wrong? This is the debate that we've been having. Ken, what are your thoughts on the question at hand?
Well, Mark, I can argue from almost any direction that we want to on this particular thing. I don't have strong feelings in any direction, except that I do like this idea of having a trigger to begin to unload some of the holdings that we have in our portfolio when they reach a 20% plus relative return in the negative direction. I will tell you that I think this is more of an argument for this particular type of portfolio, where you've added a number of different holdings over a relatively long period of time, 6, 7, 8 months. I'm not so sure that this is the style of investing that I personally do. I very rarely buy something 8 or 10 or 12 times. I might buy it twice or 3 times, but I don't have that kind of cash inflow into my portfolio to keep buying something over and over and over again. That being said, I can make the case for selling the entire ADS position if one of the purchases moves above the trigger, or in this case below the trigger, I guess. But I can also make the case for regarding each of these as a separate transaction, something that we did separately and individually, and only moving out what is not performing from the whole list right here. My wife had an idea when she was looking at this after Mark and I did some talking about it a day or so ago, and she said, why not consider looking at the position that you want to move out, and then if you don't want to sell everything else, why don't you sell anything that's about 10, 15, 20% within the area of where you are. So if we're at 24.7% and we want to move down a little bit, that would be 5 points if I move down 5% from the 24.7. So that would then sell that top position too. I think maybe that's too complicated. I had a list of what I thought we might play around with, and Mark's first reaction was, that's too complicated. So I'm thinking to myself, we're just testing. This is imaginary money. We're trying to either come up with a rule or disregard a rule that we thought might have some potential. So I would rather just stick with if it's out of the 20% range, if it's lower than that 20% trigger, relative return trigger, then sell that position. Whether it makes complete sense to do so or not, I think you can debate that up one side and down the other for a long, long while and not really reach any comfortable conclusion.
Yeah, and as far as the number being 20%, all we can do is kind of work with this and do a little bit more research. But my experience so far has been that this is not a number which is going to cause a lot of, triggering, like deadband on a thermostat, where you might have, lots of buys and sells, whatever they call that, teetotering or whatever the traders call it. It doesn't cause a hyperactivity. And keep in mind that we've been looking at a number of different investing concepts, the different portfolios that we've been applying this to. And we've only seen a couple out of several hundred case studies now, only a couple where we had a false signal where something came back and actually did quite well. So it actually has prevented a lot of capital deterioration. And by the way, we've actually already done this once in this portfolio. Back during the November roundtable, we sold one of our 8 Alliance data positions, as you can see on this graphic. And I'm thinking that we, again, remove the emotion, even as to who may have come up with the idea, and just treat it as a single decision or selection made, on a line item basis, and let the experiment continue. I will tell you that I'm with Ken also. I don't tend to do a lot of continuous accumulation of positions. I usually will go right in with a fairly decent percent of assets, but I actually have one within the last year where I did buy it 2 or 3 times. It was United Natural Foods, one that we featured at the roundtable, and it got stopped out twice, where I sold individual lots and prevented a considerable amount of damage to my personal portfolio by following this practice. So it's something that that's beyond anecdotal to me when it starts saving me real dollars. One of the things that we did promise that anytime any one of the positions of a multiple lot holding is that you would put the company under a more intense microscope. And if you actually dive in and take a look at Alliance, you're not seeing the fundamental deterioration of forward-looking revenue forecasts, and everything actually looks pretty good. The one area that starts to come into question right now is the field of analysts, including Morningstar, S&P, and a variety of others, who are concerned that competitive pressures and specific things happening in this company's field of opportunity might actually drive that PE ratio down into single digits. It's there right now. I think the current PE ratio is somewhere around 7 currently. And Value Line is still looking for a PE of 11. That was in the November 2018 report. I think if I hold this one in a portfolio and we see these type of triggering conditions happening, I think it just has to be something that's on a very high alert or high vigilance status to see if you see any drop off in any of those forecasts and deterioration of your stock studies. And who's going to be right, the 11s or the single digits. Even at single digits, this one looks pretty good right now, but again, watch very carefully over the next few weeks and see if that changes at all with some of the competitive pressures and the things that are happening at the company. So you can see there's a pretty wide berth of opinions. Morningstar is pretty, when you actually read the words of the Morningstar analysis, they're pretty nasty about it and upset with the stuff that's going on and the selling off of the partial sale of the company, the Epsilon business unit. And there are things happening here, along with the flattening of growth that you can see on the right-hand side of the business model graphic there. Any other comments on that, Ken, as far as the...
No, I'm right with you. I'm right with you, Mark, that this is an experiment. We've always been very open and upfront with the idea that it's an experiment, and an experiment, if you're going to really control enough so that you can test whether a certain variable is making any difference, I don't think you can run around and change all the variables all the time and then get any normal or decent conclusion to draw from the whole thing. So I'm ready to stick with if it falls below the trigger, let's get it out of the portfolio. And if it doesn't fall below the trigger, then it's safe.
Yeah, and I guess I tend to look at this as almost a perfect or a beautiful hedge because of that real world debate that's going on with the company. And if you exit some of these positions, you actually have protected yourself against downside if catastrophe hits, and at the same time kept 1 foot in the water, if the other side of the debate is right. So this is actually a really good case showing that you can have a partial situation, a partial sale that has some logic behind it, at least to me. So it'll be interesting to see how it unfolds, and we can look at it in more depth. And I will do an update of this here in the near future, but this is just to make the point of, is this all worth it? For the roundtable portfolio, we've actually gone back and looked at the transactions. What if we hadn't done them? If we hadn't done them, we have held on to them stubbornly, the buy and hold forever, buy and forget type mentality. Well, that's what you get with the red bar, and the return on the roundtable tracking portfolio would be somewhere around 14%. With the transactions where we've actually deployed this work in progress trial, I'm thinking of the damage that we avoided with Iconics brands, the damage we avoided with United Natural Foods, perhaps a little bit here, the stuff that we should have done with Fossil. Anyhow, that has all added up to a pretty significant advantage, the type of advantage we were kind of hoping for when we started this effort, and it has led to a 17% overall rate of return. And if it continues to pan out like this, I think we can make a heck of a case for the disciplined guidelines as they play out in a portfolio.
Okay, let's get to some of our questions then, Mark, and then we can kind of wind this down, all right? Joe says that he understood that I said that Manifest Investing members can see public dashboards by clicking tabs on the right near the top. Well, it's actually the right in the center, Joe. Mark, can you go to the Manifest site?
If I can figure out my computer, I will.
All right.
All right.
And here's Mark on the home page. And over here on the right near the center, you can see published dashboards. If you want to see a lot more, what you want to do is hit that more down at the very bottom of that list. And then on this list, if you scroll down to the F's, to the word Fortune, you'll see the one we were talking about this evening, Fortune World's Most Admired 2019. There it is there, third or fourth on the, it's moving around, but it's there, I guarantee you. And if you click on that, then you'll come to that entire dashboard. And in a related question, Sharon wants to know, why was USAA not included? Sharon, I couldn't find a ticker for that stock. Now, if you know a ticker for that stock, if you'll send it to me, I'll make sure that it gets included on the dashboard. But I could not find a ticker at all.
Yeah, and to her point, we'll try and see if we can cover BMW. We do cover Nestle. We just have to get the right ticker symbol. Publix is private. Interesting way to say that, huh? And we might be able to cover Samsung. Samsung has been very elusive. We've tried to cover Samsung a few times in the past, and there's just a real tangled web of information out there. But we'll try to add as many of those as we can. And I've got it sorted. Ken earlier mentioned opportunity. I've got it sorted by return forecast or PAR. And this is some of what he was talking about. Some of these companies that have floated to the top could be compelling studies right now.
Jay says, the market doesn't know or care when or how much you paid for a stock. My preference is to sell all of the holding. And Jay, that's the other side of the argument that we've been having, the other side of the debate that we've been having. I will answer it very simply by saying that I do know how much I pay for a stock, and one of the goals of what we're speaking of here is try to preserve capital and try to preserve capital gain. So when you put that goal in there of trying to preserve capital, then what you paid for the stock begins to matter a little bit. I understand, however, your position, and like I said, it takes two of us to make a debate, and we're sitting on the other side at the moment. Nick is reminding us that Eddie Elfenbein also has expressed concerns on Alliance Data Systems and recently removed it from the his portfolio that he picks every year. Yes, Nick, we were aware of that. Jane says USAA is an insurance company that insures the military, and she doesn't believe they're public. I have the same thoughts, Jane. I was aware of what USAA is, and I do not think it's a publicly traded company either. And we do have a couple of non-public companies on this list, okay? The last question also comes from Jane. She says, are you testing anything other than the number 20 right now? And are you considering how long you've owned the stock as you talk about that 20%? And again, Jane, we're not trying to duck your question, but we're not trying to add so many variables to our experiment that the experiment falls apart either. So we're going to stick with the number 20, that graph that Mark showed you at the end, which was how much better the portfolio is now doing. That's anecdotal evidence yet. I mean, it's over a short period of time, a relatively short period of time, and it's for a relatively small number of stocks. If we can show you a graph that's similar to this, or even better than this, 3 or 4 years from now, and if by that time we maybe have a couple of hundred different case studies of what we're doing, then I think we're prepared to suggest that what we're talking about is a great trigger. But for the moment, we have anecdotal evidence. Go on, Mark.
Yeah, one thing I would add, we did, or at least I took a brief look at 12% and rapidly reached the conclusion that that would lead to a frenzy. You know, kind of like throwing fish food at the water. Yeah, that would have triggered, in my opinion, selling some really good performers, you know, well before their time. So 2020, for whatever reason, just seemed far enough away from the volatile turbulence of the market. And so far, it's panned out pretty well to avoid that frenzy. But yeah, we have looked at that a little bit deeper, but I've not drifted off that 20 number. The other thing that we want to do that we had talked about was scaling it, you know, using quality, using price stability, that kind of thing. Again, we want to avoid that complexity. Might be something that we do longer term, but in terms of keeping it simple, because complexity probably does not add that much to the situation, we're going to try to keep it as simple as we can.
I want to thank you all for coming this evening on this potential icy evening. Thank you so much for being here and offering questions and comments and everything else. I'm looking at my question box, Mark, and it is not full of anything right now. So I'm going to say thank you so much for all that you do for this program and for the investors of Manifest Investing and Better Investing. I'm going to wish all of you in the audience a really great night, and I hope we see you again at the round table in about 3 weeks. Good night, everybody.
Yeah, the other thing that was happening while we were doing this was Illinois Fighting Illini beat the Michigan State Spartans in basketball. I had no idea that was scheduled for tonight, too.
My goodness, maybe it's hell freezing over. Maybe that's what's happening right here.
Oh, did I just walk into that?
Yes, you did. Okay.
All right.
Talk to you all later.
In 3
weeks. Good night, everybody.
Good night, everybody. Thank you.